They loom large in the public imagination, powerful, secretive, and immensely profitable. These institutions are often shrouded in mystery, their operations hidden behind a veil of complexity and jargon that only insiders seem to understand. Investment banks are the puppet masters of global finance, pulling the strings that move trillions of dollars across borders and industries. They are the unseen hands that guide the flow of capital, influencing everything from government policies to the success of small businesses. Their influence is felt in every corner of the world economy, from the price of your morning coffee to the fate of multinational corporations. Whether it's setting interest rates or determining the value of currencies, their reach is vast and their impact profound. But how much do you really know about these titans of Wall Street? What are the mechanisms that allow them to wield such power? And who are the people behind these colossal institutions? What goes on behind the closed doors of Goldman Sachs, JP Morgan Chase, and Morgan Stanley? These are not just buildings, they are the nerve centers of the global economy, where decisions are made that affect millions of lives. This is the inside story of investment banking, a world of high stakes, intense competition, and unimaginable wealth. It's a realm where fortunes can be made or lost in seconds, and where the pressure to perform is relentless. We'll demystify the complex world of finance, revealing the secrets of how investment banks operate and the critical role they play in shaping the global economy. From the trading floors to the executive suites, we'll uncover the strategies and tactics that drive their success. From underwriting billion-dollar initial public offerings to brokering mega-mergers, investment banks are the architects of the modern financial system. They design the financial instruments that fuel growth and innovation, and they provide the capital that companies need to expand and thrive. But their power comes with responsibility. The stakes are incredibly high, and the consequences of their actions can be far-reaching. A single decision can ripple through the economy, affecting everything from employment rates to the stability of entire nations. The decisions made in the boardrooms of investment banks can make or break companies, create or destroy jobs, and even destabilize entire economies. It's a world where the stakes are as high as they come, and where the margin for error is razor thin. Understanding the world of investment banking is essential for anyone who wants to grasp the dynamics of the global marketplace. It's not just about numbers and charts, it's about understanding the forces that shape our world and the people who wield those forces. So buckle up and prepare for a thrilling ride through the canyons of Wall Street, where fortunes are made and lost in the blink of an eye. This journey will take you deep into the heart of the financial world, revealing the drama, the excitement, and the high-stakes decisions that define investment banking. Investment banks are essentially financial supermarkets, offering a smorgasbord of services to cater to the needs of corporations, governments, and high-net-worth individuals. These institutions are the backbone of the financial world, providing the necessary infrastructure for economic growth and stability. These services can be broadly categorized into three main pillars: underwriting, mergers and acquisitions, and trading. Each of these pillars plays a crucial role in the financial ecosystem, ensuring that capital flows efficiently and effectively throughout the economy. Underwriting is the process by which investment banks help companies raise capital by issuing securities, such as stocks or bonds, to the public. This involves a detailed analysis of the company's financial health and market conditions to determine the best strategy for raising funds. Think of it as being the financial midwife for a company going public. The investment bank takes on the risk of selling the new securities, ensuring that the company gets the capital it needs to grow and expand. Investment banks act as intermediaries, connecting companies seeking capital with investors eager to park their money. They provide a vital link between those who need funds to grow their businesses and those who have the capital to invest. Mergers and acquisitions is the arena where corporate empires are built and dismantled. This pillar involves complex negotiations and strategic planning to ensure that the merging entities create value for their shareholders. Investment banks act as matchmakers, bringing together buyers and sellers for mergers, acquisitions, and other restructuring activities. They leverage their extensive networks and industry expertise to find the best possible matches. They advise their clients on valuation, negotiation, and deal structuring, ensuring that the transaction is mutually beneficial. This advisory role is critical in navigating the complexities of corporate finance and achieving successful outcomes. Trading, the heart and soul of Wall Street, involves buying and selling securities in the secondary market. This pillar is characterized by its fast-paced environment and the need for quick decision-making. Investment banks employ armies of traders who operate at lightning speed, exploiting minute price fluctuations to generate profits for themselves and their clients. These traders use sophisticated algorithms and real-time data to make split-second decisions. This high-octane world is not for the faint of heart, as fortunes can be made and lost in the blink of an eye. The pressure is immense, and the stakes are incredibly high, making it one of the most challenging yet rewarding aspects of investment banking. These three pillars form the bedrock of investment banking, providing a comprehensive suite of financial services that are essential for the functioning of modern capital markets. They ensure that capital is allocated efficiently, risks are managed effectively, and economic growth is sustained. The life of an investment banker is not for the faint of heart. It's a career that demands not just intelligence and skill, but also an extraordinary level of dedication and resilience. Long hours, intense pressure, and a relentless pursuit of profit are the norm in this high-stakes world. The stakes are high, and the margin for error is slim, making every decision critical. A typical day for an investment banker can start before sunrise and stretch well into the night, fueled by endless cups of coffee and the adrenaline rush of closing deals. The office buzzes with activity, even as the rest of the world sleeps. The day usually begins with a review of market news and analysis, catching up on overnight developments that could impact their clients or deals. Staying informed is crucial, as the financial landscape can shift rapidly. Client meetings dominate the day, whether it's pitching for new business, providing updates on ongoing transactions, or brainstorming strategies for future growth. Each meeting is an opportunity to build relationships and secure future deals. Number crunching is a significant part of the job, with bankers spending countless hours poring over spreadsheets, building financial models, and conducting due diligence on potential investments. Accuracy is paramount, as even a small error can have significant consequences. Negotiations are another crucial aspect, as bankers advocate for their clients' interests, haggling over valuations, terms, and conditions. These discussions can be intense, requiring both strategic thinking and persuasive communication. As the day winds down, there's always more work to be done. The to-do list never seems to get shorter, and the pressure to perform remains constant. Preparing presentations, drafting documents, and responding to a barrage of emails are all part and parcel of the job. Each task requires attention to detail and a commitment to excellence. The life of an investment banker is a constant juggling act, demanding exceptional stamina, analytical skills, and a high tolerance for stress. It's a challenging career, but for those who thrive on pressure and complexity, it can also be incredibly rewarding. Imagine a company transforming from a private entity to a publicly traded giant. Its shares available for anyone to buy and sell on the stock market. This metamorphosis is achieved through an initial public offering, or IPO, a complex process orchestrated by investment banks. Acting as financial advisors and underwriters, investment banks guide companies through the intricate steps of going public. They assess the company's financial health, determine the IPO's timing and pricing, and create a compelling prospectus to entice investors. The investment bank then acts as a conduit, connecting the company with potential investors, typically institutional investors like pension funds and mutual funds. On the IPO day, the company's shares are listed on a stock exchange, marking its official entry into the public domain. The 1995 IPO of Netscape, a pioneering internet company, is a legendary example of investment banking prowess. Morgan Stanley, the lead underwriter, navigated the then uncharted waters of the dot-com boom, successfully taking Netscape public and ushering in a new era of internet-based businesses. IPOs are a testament to the power of investment banks to unlock capital and fuel economic growth. They transform fledgling startups into publicly traded behemoths, creating wealth for founders, employees, and investors alike. In the high-stakes world of corporate finance, mergers and acquisitions, often called M&A, are the ultimate power play. Companies driven by ambition, strategic alignment, or simply the desire to eliminate competition often turn to investment banks to navigate the complex process of joining forces or acquiring rivals. Investment banks act as strategic advisors, guiding their clients through every step of the M&A process. They identify potential targets, conduct due diligence, value businesses, and structure deals that maximize shareholder value. Negotiation skills are paramount, as bankers deftly navigate competing interests, ensuring a fair and equitable outcome for all parties involved. One of the most audacious M&A deals in history was the 1999 merger of Exxon and Mobil, two oil and gas giants. Orchestrated by investment banks Goldman Sachs and Morgan Stanley, the $81 billion mega-merger created ExxonMobil, one of the largest publicly traded companies in the world. This landmark deal reshaped the global energy landscape and demonstrated the transformative power of strategic acquisitions. M&A transactions are not without their critics who argue that they can stifle competition and lead to job losses. However, when executed strategically, mergers and acquisitions can unlock synergies, drive innovation, and create long-term value for all stakeholders involved.